Hi, this is Randy Finney with Right Side of the Chart, and this is video number 2 for Monday, March 4th, 2024. It's 1:30 p.m. exactly as I'm starting this video, so we've got about 2.5 hours to go in the trading day. And the last video, I encourage you watching it. I covered, did updates on a lot of the trade ideas I threw out recently, and as I like to do, replied to some of the questions and or comments on the site. Had a detailed kind of talk about diversification as well as portfolio sizing. I'm telling you, those are the two things that'll either make you or break you in investing and trading. So I encourage you, if you have a minute, to check out that one. And so what happened that video, as I thought it might, because I was going into detail on trade ideas and then kind of tangentially off on answering some of the questions or comments regarding some of those recent trades. The video, I chopped it off and figured I'd do the equity markets in a second video, which I'm going to do here. So here's what I'm going to cover. Keep it very simple. You know, the major stock indexes like I usually do. And then I'll just breeze through the 11 sectors, or not even all 11, but the ones I highlighted last week. Remember, I've been highlighting key support levels down below that need to get taken out in order to open the door for the next correction, drop, start of bear market, or resumption of the bear market, whatever you want to call it. Again, it's semantics. We're going to use I do the kind of the shorter term charts, intraday 60-minute charts and or daily charts to kind of decide how and when to position, and then the longer term charts. That's why I do cover those so often. Formulates where things are going to go over time. So in this video, again, let's get into it. We'll start out with the QQQ here, a couple economic indicators and things I want to talk about as well. But it won't be a super long video because I already covered most of what I needed to on the trade ideas in the previous video. So QQQ, this is that clean board. Remember, we had the breakdown pre-NVIDIA earnings, then the snapback. We've been back testing it, and we're just really going above and through that trend line. So I'm telling you, at this point in time, it's meaning quite a bit less to me right now. Now, that doesn't mean that if we get way far from it, it's not technically significant. But I am putting, at this point in time, I'm not going to try to read too much into a little slight close above or slight close below. Hopefully that makes sense. It's just, kind of trading around through it. But what I do feel pretty strong on are those levels that I gave you last week. And even in prior weeks, but last week on the sectors of the S&P 500, particularly the most important sectors, and then those key levels on the market-leading tech stocks. Those, I believe, are the most important things, as well in conjunction with what Treasury bonds do, as well as the euro and U.S. dollar. So let's jump into that. Let's before we dive headfirst into the stock market and all the sectors, let's just do a quick update. I did get one out to you this morning on IEF because I think that's important. So kind of to recap, if you're just catching up, this is back here before we even entered it. I named it the yellow zone. Stock market would start to take note of rising yields, and it did. At that point, stocks were going down, and then boom, we had this breakout here coincided roughly with NVIDIA earnings, I believe, and it gave the stock market another lift, which in turn, sometimes it's the chicken or the egg thing with the bond market and stock market. But ultimately, this is, if you're going to watch one chart other than anything to do with stocks or the stock market to try to figure out where the stock market is going, I think this is the one to watch. Now, fortunately, you're not limited to one chart, but I do, my point is, I think it's a very important one to watch. And so the yellow zone, so we had the bullish falling wedge, the positive divergence. We broke out and we zigzagged higher, at which point I said, rally up to the top of the yellow zone, certainly very likely. It could be a price target if you're swinging it long. Even before and after, right after the breakout, I said you could even go long treasuries as a hedge if you do have index shorts, because if treasuries go up, you'll profit there, and the stock market should rally as well. Remember, treasuries up, like this chart is showing, it means bond yields down, and that's bullish for the stock market. So there's that very strong positive correlation I've covered many times in the past between treasury bonds, particularly the 10-year, which we're looking at here. And so, boom, you hit it to the button. And so far, nothing at all to high five. It's not doing a lot to the stock market. The Qs are, as I talk, we're slightly in, the S&P slightly negative, but again, nothing much. But it's not mere coincidence. In fact, QQQ is down. Look, we're down 0.28 on IEF, the 10-year, and QQQ is down 0.2. So again, you can blindfold me and just let me only see the chart of IEF, and you can sit there and almost trade the equity markets. And again, this is pricing and a lot of stuff. Market forces are setting these 10-year rates, and it's in the stock market, and where it goes from here is all about, well, then I have to digress. Lately, it's been all about what Powell's going to do and what the rate cuts are going to be. And again, I talked a little bit about that in the last video. I'm starting to see more and more, and I'm going to get to that in this video because we're talking about the equity markets, more and more leading indicators roll over and confirm where, it looks like the market's going and the economy's going. And lately, bad news for the economy has been good news for the stock market, because you see bonds rally, you see yields come down because the market immediately assumes that the Fed's going to have a better chance of cutting or give us more cuts. And yes, they will. But again, as I said in that previous video, that happens for a little while. Economic indicators and news in the economy doesn't matter until all of a sudden it does matter. In every single cycle, remember, the Fed has not eliminated the business cycle. They've only prolonged it and extended it. And so, again, we'll get to those economic indicators. And that's kind of bigger picture stuff. But in trading, this is it. This is a hard level. This is what I'm giving you right there. It's 94.50. It's not the be-all, end-all. I've talked about the scenarios where you could see Treasury bonds rally with yields going down in a flight to safety bid. So we'll just have to see if we get in the green zone. Why are we in the green zone? What's the stock market doing? Again, all of the things that should be net bullish for the stock market, but net bullish doesn't always guarantee bullish. It just means, of the two, it's more bullish than bearish, but sometimes the bond yields are going up or down for different reasons. All right, either future expectations of interest rates and or economic growth, which is normally the case, but there are times, again, where institutions are suddenly flocking into Treasury bonds as a move into safety, selling stocks and going into bonds. I'm going to give you a little micro level. Just as I'm doing the video, I noticed here, we have boom, boom reactions there. We popped it. And so we're sitting on that now. So I think a break of under today's lows, or about under $94, should bring us back down. And then remember, last week I raised my orange zone, which is right here. It used to be here. And I moved it up to place it just below the recent lows, because we've had enough reactions there that I do believe that if and when that level is taken out anytime soon or anytime in the future, I believe the market will really begin to take note. And that's what the orange zone says. Stock market really starts to take notes of rising yields. And then, of course, the red zone, if we get there, I would be shocked, not surprised, but shocked if I'm wrong, if we happen to get in this red zone and the market's not selling off pretty hard. But again, first things first, guys. And the first thing is this, 94 right there, today's lows. Second thing is 93, 43, whatever the recent lows are. So that's how this thing works. And then if it does this instead, and we go up here, and we start moving up here, what does that mean to me? I'm just unless again, I see a reason, stock market's breaking support, all the market leaders are breaking support, and institutions are selling NVIDIA and Apple and Amazon and flocking in treasuries. That's the one exception where I'll, stay in that short the rip mode. But otherwise, if it does it in a healthy fashion, and all the everything I'm about to cover in this video remains above support, and we don't get any more sell signals. Remember, we got one today on Apple, but as I continue to say, one of the Mag 7 or whatever you want to call them breaking down doesn't necessarily mean the whole lot's going to go down. In fact, it almost guarantees that if the rest don't break down and start to follow suit, then the breakdown in Apple will prove to be a false breakdown. But as of now, Let's take it on faith. The breakdown's a breakdown. We'll get to that in a second. So there's your update on bonds. It's pretty simple. Again, color coded. The levels are there. I don't think that could be any easier. But again, it's only one of several things that that I'm watching that will determine where we go from here. Let's go into the markets themselves. I already did QQQ. Again, you can just back test, but this is a 60-minute chart. The other thing that has a big impact on the stock market is the euro-US dollar pair. Also trades just like the 10-year Treasury, positively correlated because this is the euro. If the euro goes up, it means the dollar's falling. That's bullish for equities. One of, if not other ways, of course, but one of it's just like gold. The dollar's worth less. If it's dropping, then it takes more dollars to buy one share of Apple or QQQ or whatever. But again, you can, and I've done it many times in the past. I don't want this to be a super long video, so I'm not going to do it here. Encourage you to overlay, or the easy way to do it is FXE or UDN, which is the inverse dollar. Compare either of those two, overlay with the stock market, and you'll see, especially since beginning of late 2021, early 2022, a very strong positive correlation. And so we're still below and back testing that trend line right there, this primary trend line off the September lows. And it's no coincidence, this is when the stock market bottomed right after that, October 2022. And again, if you overlay the two, you'll see these major trends are very correlated. So if the euro does this, then that will be net bearish for the stock market. If the euro can regain that level, especially if it can pop above that previous high, then that should be net bullish. Again, so that's one of many things. But let's just roll to the Mag 7, then we'll hit those sectors real quick. So Mag 7, Microsoft. I've highlighted some nearby levels recently with the white lines being less significant, and that's this gap, Microsoft right here, the gap from a couple weeks ago. And then you have the top of this gap here. But in this, Microsoft's been dancing around actually between both gaps. You can look really closely. Here, I'll put another line here. There's the bottom of that gap. So we went into this gap, we backfilled it and got rejected. And then we fell back down below it, backfilled the other gap, bounced. So that's Microsoft's ping-ponging right now between the gap. But again, absolutely, those are just minor support levels. The big ones are in yellow. So until I see the majority of these, big tech stocks take out my yellow levels, and this again falls on deaf ears on the site. Just like back here, we had to take out the purple levels, which not only did we not take them out, but we went long off those. I said, look, time to cover all shorts and go long because we're at support. We have divergences and we're probably going to bounce off these levels. And had they turned around and that proved to be, it failed and then we went down through, then I would have just closed longs and shorted. But that's it. So, and because somebody said, oh, we keep getting farther from the purple lines. Of course we do. They were support levels. They were great. And I defined at the time, excellent, very significant support levels. And they held. And so support is support until unless broken. So they're every bit as important now. And I gave that analogy in the last video, kind of betting on a sports team in advance to win the championship game before the season even starts. First things first, before laying that bet. If I was betting on the Dolphins to win the Super Bowl next year, again, I'm not a sports bettor, but I'd wait till they won, at least secured the AFC championship, and we knew they were going to the Super Bowl. Same thing here. So I might talk the long-term talk. And again, it works this way to me. Odds will tick up when my yellow lines are taken out, when the 200 days are taken out. And it's kind of just like betting the ponies or anything, in real time, or sports betting. Throughout the season, again, you bet one team, that the odds are going to change throughout the season. They're going to change from the beginning of the season as each weekend as the games are played and as injuries occur and other factors come into play, the odds are going to change. So I don't know any other way I can keep saying that. And I know it's just a handful of folks, but so these are, as of this point today and for the last week or so, these are the most important levels to me. And again, collectively, if I start firing off sell signals on the majority of these, IEF confirms what I want to see and all that, boom, then you've got, objective short. And likewise, I've said repeatedly, pull back to support, highlighted these levels, and you can certainly go long if you are looking for objective levels to get long, because they are important support levels. So there's Microsoft. No sell signal yet for the bears on this, at least not until that yellow line's taken out, and 397, which is, the other day they came in together. They're a little bit below. Apple, yes, sell signal, a little checkbox there, but it's only one of, out of the Mag 7 and 1 out of 7 if you want to just use those names. NVIDIA, no, nothing. 742, not even close, and then even better when the purple trend line goes. So no check mark there. So far we're 1 for 3. Amazon, nope. We've got trend line 1, trend line 2. Now this one being more significant, but it's still 167.74 remains the yellow line, and then the purple line down there. So we're now, what does that make us? 1 for 4. We were just 1 for 3, I think. So no sell signal there. Alphabet I didn't have because I'm just leaving my purple lines. I didn't have a yellow line because it's been sloppy trading, but I did want to point out we're at the 200-day moving averages. And what does that mean? Go to a clean chart here. These blue and red lines, we're on a weekly now, but I always say the 40-week moving averages on a weekly chart, or the 40 period, is the same thing as a 200-day on a daily chart. 200 period, because there are 5 days in a week. So 5 times 40 equals 200. And so you can see, again, bull trend. Alphabet trades above the 200, buys pullback. That was a bear trend. Doesn't look like a lot. Double-digit drop, lasted several months. Sliced through it a few times. COVID right there. And then since then, boom, boom, support, support, support. Gave it up there. We had a bear market in Alphabet. Took him back there. Successfully tested here, and we're on them right now. So just a key level to watch, and if anything, those would be my yellow lines, but I'm just leaving them the colors I have. And so we're testing them right now. This is a more significant downtrend line there. There's my purple lines. Again, these are from back last fall when we hit and went long, and I just had XLC fire an alert. I'll get to that in a second when I do the sectors. Okay, Meta still above the 450, 443, and the primary uptrend line. Big level there, that uptrend line, major level. Again, pointed out back here, we keep walking up that trend line. So that's what the big one, and Tesla. Okay, Tesla I covered today. It was timely. I got it out to you. We just broke this trend line today. Looks like unless something crazy happens in the next 2 hours, it's safe to say we're gonna print a close below there. So that bear market rally's over. A few weeks back, a couple months ago, I said of all the Mag 7, this is the only one I would consider buying. I said I didn't buy it, but if you wanted, it's a trade idea. We had a bullish falling wedge, positive divergence, and it outperformed even, I believe, probably over that time frame. The video, we're up 16%, maybe not, but I know it definitely outperformed the rest of the lot of the Mag 7. So there it is. There's your update. So that is, even though, well, yeah, I did. I guess, did I put this purple line there recently? I can't remember. Tesla's kind of already broke down. It's already in it's well off its highs, and so you can give that a check mark. Although I don't think I included it in my initial. It wasn't all Mag 7. It was just the majority. I had those yellow lines. So either way, I just want to say this is net bearish for Tesla today. And of course, if it takes out the recent lows, that's going to be even more bearish. So that's kind of your update on the Mag 7. We've got Apple breaking down. Now let's look at the sectors of the S&P, and I'll show you a few economic indicators and charts, and we'll wrap up here. All right, so XLK, Tech Sector ETF, of all of them, the most important. And remember, when I go through these, and I'll tell you I'm doing it now, I have a list of the 11 sectors in the S&P 500, and I have them sorted by their contribution to the S&P. I haven't updated this in a while. I keep meaning to, but either way, I know it's still the highest. A little over a year ago, it was at the end of 2022. Yeah, so a little over a year ago, it was 26% weighting. Over 1/4 of the entire S&P 500 was made up of just this, or attributed to the returns from this one sector out of 11 sectors. So of all of them, that's the trend line you want to see go. When that one goes, that's pretty significant. But we're well above it right now. XLV, healthcare, dancing on it. I told you last week, call it a fool's errand, but I think these all look ripe for breakdowns based on the divergences, the overbought conditions, and how they're just kind of hugging these trend lines lately. But no sell signal yet. So there's 0 for 2 right now on the sectors. We're only one for really one, if you want to call it 2 for 7 on the. Remember, Tesla's no longer a Mag 7. Tesla's long. Tesla peaked years ago, and it's way, way, way off its highs. So it's really not a Mag anything anymore. This is XLF financials, just right on the line. So I've got, told you I have alerts set for all of these. XLY, consumer discretionary, pretty impulsive reversal, but still well above the trend line right there. And I'm just looking at a little horizontal support right about there. So no sell signal there yet. XLI industrials, nothing close to a sell signal right now. There's your yellow line. XLC, it's firing alert, but we're not, I want to see a solid intraday break and or a daily close below it. And I'm going to give you one more level now, because this is what I do. As I often say, the charts are dynamic and so is my analysis. If you want a BOD level, then this is it right here. BOD meaning benefit of the doubt, because that is the bottom of this trading range. If you look at it this way, XLC has traded, the communication sector has traded in this range recently. So a trend line break should do the trick, and a break below 78 should seal the deal. Your 200-day moving averages are all the way down here. And this sector is mostly made up of Meta and Alphabet, those two combined. And Alphabet's kind of sucking wind, as I think I showed you today, testing the 200s now. All right, and we go down the line, you get to XLP, right on the line, but not going to move the needle as much. Now you're down to about a 7.2 or so % weighting. XLE energy, like I said, if anything, one of, if not the only bullish looking, more bullish than bearish, coming off a divergent low. Obviously, I've been told long natural gas lately, and net bullish, but more watching crude than being bullish in positioning. But crude breaking out and back testing. So, and again, this is a sector, although it attributes, weighting to the about a 5% weighting to the S&P. So if it goes up, it should help the S&P. But if this sector is going up, it's because oil's going up, and if oil's going up, that ain't good for Powell, or the market. So the market does not want this sector to make any contributions to the S&P, and it's like I said, one of the better looking ones. XLU utilities, 3%, not going to move the needle. It's a rate sensitive sector, really. And it's also a defensive issue, so that's the other thing too. If you start seeing this break out and go up, sometimes that's institutions moving from growth stocks into the cyclical, or not, I'm sorry, away from cyclicals and growth stocks into the recessionary defensive issues such as utilities and sometimes healthcare, things like that. And there's XLB, basic materials. There's your trend line. But again, not going to move the needle. I'm at the bottom of the rung now as far as weightings go to the S&P. So you can watch them. You can trade them if you like them. And this is XLRE REITs, which have been beat down and still, like many things, way off their bull market highs. A lot more, turn off the levels. A lot more appears to be in a bear market than a bull market. Okay, let's look at a few economic indicators real quickly. And this one is the on websites Trading Economics. I've got a lot of great charts. You can sort them by all kinds of stuff. Markets, GDP. This is under business. So this is a leading economic indicator. And they tell you what makes it up down here. Conference Board. LEI is a predictive variable that anticipates or leads turning points in the business cycle by around 7 months. I can tell you a lot of what you hear on CNBC are talking, they're concurrent indicators, whether or coincident, whether they call it that or not. It's been my experience, things like the job market and consumer confidence, those are more coincident indicators. So the 10 components of the Conference Board leading economic index for the U.S. include average weekly hours in manufacturing, initial claims for unemployment insurance, manufacturer new orders for, you can read it, guys. Go to the site if you want to know what's in it. But you can see here, and I went to the Federal Reserve site too, and they only go back, you can only go back to 2000, but we know that the last real big bear markets or really the last three, technically speaking, bear markets, if you want to use antiquated 20% drop on all the indexes, was that when the dot-com bubble burst right here, 2000. Remember, this started rolling over first because these are leading indicator, predictive value. So it peaked here and looks like 2006 or something. Let me see if crosshairs. No, they don't give me crosshairs on it. But the market peaked in October of 07, which would have been somewhere in here, after this had rolled over and then started falling off a cliff. And that was the Great Recession. That was a 56% drop in both the S&P and the NASDAQ 100. Here, the NASDAQ composite fell almost 80%. The S&P less, but NASDAQ fell. And then there's COVID right there. And you can see it already rolled over. It was rolling over before COVID even hit. It's not rolling over now. It's downright crashing. It's it's dropped off at a rate which typically only see at this point you're already well into a bear market or recession. Again, take it what you want. I'm not making this chart up. You can see there's no turn in this, and you can see where where it's been heading, where it's peaked in the last, and moving down. Again, now I make up some of my own leading indicators too, and those are just simply looking at. There's a handful of stocks, Paychex being one of them that I look at. Because most of you, if you work for an employer, you're probably familiar with Paychex. They're one of the biggest payroll processing companies out there. Or ADP. We can look at ADP or Paychex. ADP is even bigger. I'll do that in a second. But here's a weekly chart, and basically what we're comparing here in green is the S&P 500 and white is Paychex. And you can see here, this was right here. Peak in SPY. You can see them both falling together. I'm probably going to go to ADP because that's the one I usually go with. I typed in Paychex. I don't know why that was on my mind, but you can see both of them falling. Both of them, quite often Paychex will peak first, like it did back in 09. It starts to fall. The market goes on to make a new high, and then the market falls. Either way, you cannot argue when you look at the correlation here. It's an almost perfect correlation. And there's just a few instances, and zero instances when I go back in time, and especially ADP is my go-to. Again, I keep in my head, I just typed in because I was thinking payroll, Paychecks. I'll get to ADP in a second, but you can go back in time, and any major inflection point in the markets, there's never been a case where the S&P is at new all-time highs and Paychecks not. And that's the thing. You can look at it, when it peaked, Paycheck, here, I'll go to ADP like I keep saying I will. There's ADP, the S&P 500. You can see the S&P 500 peaked right around that same, we had a little bit more updraft that was in 2000, the dot-com bubble. The one to compare would probably be NASDAQ on that, but you can see they both peaked there, started moving down, perfect correlation right here. ADP peaked first. The S&P went up. There was some divergence there leading into the bear market of 2007 high. This is when the stock market, there's the S&P peak, there's Paycheck peak. Paycheck started going down. We had a little dip down in the S&P and then a new high. Paychecks didn't make a new, or ADP didn't make a new high, and then they both bottom around the same time. And you can see again, a virtual perfect correlation on the two. COVID, this one didn't give you any lead time. It did on Paychecks. That's why I look at them both. Just like FedEx and UPS, I look at them both, and you can see the correlation. But what really stands out to me is this divergence recently. Again, a couple things. Number one, ADP and Paychecks, they peaked back here. They peaked in late 2022. So all you've been hearing, for the case for this bull market to continue for a long time is how strong employment is. What is this telling us? Again, if you dig in the employment numbers, there's a tremendous flaw when you listen to people that really know what they're talking about, that study, they do the economics and all that, economists, sorry, about the seasonality adjustments to the government's numbers, which are just kind of crazy, the whole birth death model and all that. And then, of course, when you dig down and you look at jobless claims, the studies, the numbers show that, you have hours worked are really reducing. Employers are very slow to let people go because they're still shell shocked from COVID. It was so hard to find employees. So what they're doing, they're reducing hours. hours worked has been dropping, and the number of jobs being worked. If people out there working 2, even 3 jobs, and they're counting as new jobs, but yet they're doing that because they're not employed full time anymore. So a lot of indicators. And this again, this tells you. You can see these lower peaks in ADP in the stock market here at new highs. There's the stock market. There's the high right there in the S&P. And the other one, as I said, you can look at UPS or FedEx. And FedEx, these are great economic indicators. I've shared this chart in the past. The yellow lines show you when FedEx is in white. FedEx peaked right there. That was the end of its bull market, clearly going down while the S&P went on to new highs. Again, these are just, there's not many. These are the real bear markets that we've had for decades now. That one was clearly anticipated, if you will, predicted, whatever you want to call it, by a peak in FedEx. And I think you all know why. Obviously, FedEx is, the economy is strong. FedEx is shipping more packages and envelopes and stuff, and vice versa. There it is again. FedEx peaked shortly after that. And one of the videos I put up the stats. I don't know where it was, where I had the time period. Maybe it was in UPS. I don't know. But again, there's really no exceptions. You had a peak in FedEx. Then the stock market, the S&P peaked, and then you had, that was the Q4 of 2018 big drop there. Doesn't look like much. It was double digit, almost 20% drop in some indexes, many stocks. COVID right there, kind of a concurrent peak right there before we had the, whether you want to call it a bear market or correction in late 20 or throughout 2022. And here we are now. And this is, again, this is something that I'm not squinting to see. It's first of all, FedEx didn't just peak right here. It did most recently with stark divergence while the S&P is going the complete opposite direction. That's very unusual. This is where FedEx peaked, and it's been in a downtrend since, like so many other stocks, well off its highs. And so again, these are the things that I look at in addition to the run-of-the-mill leading economic indicators that I've shared lately. That's mostly it. There was a comment about RSP, and yep, how the equal weighted has moved up lately, and it's not far off highs. I can only go back to, RSP is an ETF, so you only have back here 2003 is when they launched that ETF, so that's as far as you can go on price history, but you can also type in the equal weighted S&P 500, in which case, yeah, you're going back to 03. So I had this chart marked up right here. There it is. I already had this one from a while ago queued in with all these white arrows without fail. And you also have, the arrows aren't on there, but you have the divergent lows that we've had over the past several decades. But most important, and without fail, there's no bias or exceptions here. There was a divergent high on the weekly. This is the longer term, bigger picture, divergent high. And now we're not there yet. We're slightly below, but for all intents and purposes, you have negative divergence when you have equal or slightly higher highs. So, and I've talked about this before. It's semantics, whether you want to call. I'm viewing this because the vast majority of stocks, and these are the largest of all. The S&P 500 are the 500 largest companies in the U.S., right? It's not the stock market. It's so far from the stock market. There's many, 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 many more times small and mid-cap companies out there. So again, this is not you've seen a little spike in market breadth recently on this, but it's not the stock market. And again, without fail, 61% drop after that divergent high, 25, 19, 40. There was COVID. COVID was not a random event, at least not technically. It was predicted in the charts. The drop on the equal weighted measured out to be about 24% off the early 2022 highs. And right now, this is an equal and any equal or marginal new high anytime soon, because of the posture of the indicators, is 100% guaranteed to be a divergent high. That doesn't mean they can't punch through there and go on up. All it tells you, again, trading is about probability, putting odds in your favor. And you look at this chart, and that's where technical analysis evolved. At some point way back when, before the crash of 29 even, when you had Jesse Livermore, great tape reader, technical analysis was in its earliest form. but it was, a study of, of really the charts or where buyers and sellers interacted before, and then recognizing certain patterns in the market, and then being able to predict what may happen next when you see similar patterns. So that's all this is. And there it is. So, and again, this is macro long-term stuff. This is where, as of today, if these targets are hit, I just threw out a couple, rough targets on the equal weighted. Not that I'm trading the equal weighted, and not that I'm trading the S&P at all, but 12% drop from where we're at now. If that first one's hit, no, I'm sorry. Why did I do that? It must have been to the top level. That is where we're at now. Let me just fix that. I did that this morning. So it's about 28, almost 30%. We'll just round it off 30%. In this one, I should be right at about 47. Yeah, 47%. So again, this is not a timing call. This is more of where the big picture, where I think the equal weighted will be within the next year to two. And now it took years to get up to this level. From that level, it took, in fact, oops, didn't mean to move my line, but I'll put it back. It took roughly, let's grab that line, move that over. That tells me it was 3.4 years. So why am I thinking the next year or two? If it took 3.5 years just to get to this level, how can I predict within 1 to 2 years we'll go down? It's simple. Stocks almost always fall, especially in corrections and bear markets, a lot faster than they rise. It is the norm that in just a matter of months, or maybe a year, year and a half, years of gains are usually wiped out. It's just how it works. So that's what we're looking at. So what do we need? Well, of course we need some sell signals. Got a little trend line there. And the sell signals are what I covered in the beginning of the video. Again, I have no plans to trade RSP. In fact, when the next drop comes, I can almost guarantee you, not guarantee, but almost guarantee you that the regular SPY, the non-equal weighted, will outperform to the downside as the money flows change hands. What's kept all the Mag 7 going up is every dollar in everyone's 401k, it gets spread out at a disproportionate rate into buying those Mag 7. And the same thing happens reverse when the market, when the flows go the other way. Selling begets more selling, and the indexes, as people are redeeming, pulling money out of their S&P 500 index funds, moving into bonds or cash, crypto, gold, whatever it is. Then Nvidia and Microsoft and Amazon and Apple, they get sold more proportionally than do the smaller ones. So I was just sharing that to show you, what the chart looks like. And same thing on the S&P 500. It's not much different when you get a weekly chart. You've got the bigger divergence that I just showed you on RSP. That's the bigger divergence that it's been building for quite some time. And that's just one of many boards I have on the S&P. But those are key trend lines to watch and other things like that. Fibonacci levels. So that's it. I'll wrap it there. There's 30 plus minutes talking about the indexes, but waiting for sell signals that have yet to come for the next add-ons. And again, if you are, I'm going to just end the video. I don't want to, I do need to make clear we had some sell signals on the shorter term on the 60-minute charts for active traders, which may have been, already covered, taken. The trend line break there, then the pre-NVIDIA break, and we're back testing. So I will view this, and again, I spoke to this, made very clear at the time as far as the trading plan, my plan suggested was incremental. Starter short there, second on that break. Those were the only two sell signals. And then any kickbacks are objective short entries, but at this point, because we're right on the lines, you can obviously make an objective case to short there. Again, especially if you had no positions. Other than that, wait for at least the majority of those key levels on the market leading stocks and or the sectors to give way, and your odds are going to shoot up from now. Say you threw or shorted the market today and you were betting on the next 10% move. It's a binary trade, 10% up, 10% down. I would put probably 65%, 60 to 65% that the next 10 is down. So that's favorable odds, but it's also a pot shot right now. somewhat, back test, but wait for the majority of those sell signals to come, and I'm going to say that shoots up to about 80 to 85% in my head. That's good odds. Those are the kind of odds I like, and that's where you go from either a no short position or a partial short position if your plan is like mine and long-term accounts, scale in some long-term positions to take it up to a full position at that point. And of course, in the active trading accounts, that's different. And I posted a few of those lately. A couple people thanked me and like those. So I had probably my head bit off more than anything. People, this is not a day trading site. Like I said, take them, don't take them. Every now and then I see something. Right now, there's not much. Last 5-minute charts, we had this little breakdown here, back test. We hit that target and then that target. Then we bounced, and here's where we're at now. There's really not much there. There was a little uptrend line. I haven't been actively trading in the last couple days. This is just blah. I don't have my divergences I like to see. Again, at this point in time, I'm just kind of sitting, focusing, waiting with alerts set to get a bunch of those sell signals to move in for the equity markets. Now we're done, 40-minute mark, but remember the previous video went longer, covering over a half dozen trade ideas, which are going up. Collectively, the vast majority of those are playing out, and they're playing out for much bigger gains than the stock market is. Any short positions currently on the stock market are going down. So that's where the meat is to be made right now, or the shearing the meat off the bone. And it will be at some point in the future on the NASDAQ 100 and small caps and all that, but we just have to get those sell signals. I will wrap it up here. This has been Randy Finney with the right side of the chart. Have a great day.